Welcome to another episode of Market Brief After Hours. We're wrapping up a very busy and frankly rather turbulent day in the global financial markets. It seems like investors everywhere are grappling with some heavy headwinds, from multi-decade highs in global bond yields to rising oil prices and a pretty sharp pullback in some key sectors like technology and precious metals. Let's start with the big picture. What was the main driver behind the sell-off we saw on Wall Street today?
Today was really a story about the relentless pressure from the bond market and energy costs. We saw the S&P 500 fall for a third consecutive session, dropping 0.69% to close at 7,692. The Nasdaq Composite took a heavier hit, sliding 1.33% to finish at 26,290. Even the Dow Jones Industrial Average couldn't escape the red, shedding about 116 points, or 0.22%, to end at 53,343. What's really driving this is the surge in sovereign bond yields. The U.S. 30-year Treasury bond yield reached a fresh 19-year high today before pulling back slightly to settle around 5.285%. When yields rise like this, it increases the cost of capital and makes equities, especially high-growth tech stocks, look a lot less attractive.
And tech certainly felt the pain today. I noticed some massive drops in semiconductor and memory stocks. What happened there?
Absolutely. The semiconductor space was a major drag on the Nasdaq. Western Digital plummeted 7%, Sandisk dropped 9%, and we saw Marvell Technology and Seagate Technology down nearly 8% and over 9% respectively. It's a classic case of profit-taking mixed with rising interest rate worries. When yields go up, investors start questioning the high valuations of these tech giants. As one portfolio manager noted today, the market has been trying to overlook the challenges in the bond market by focusing on solid earnings and AI developments. But at some point, the market becomes vulnerable to a sell-off. And those bond market pressures aren't going away overnight.
Speaking of things that aren't going away, let's talk about oil. We saw crude prices creeping up again today, which only adds fuel to the inflation fire. What's the latest on that front?
Oil is a massive piece of the inflation puzzle right now. U.S. West Texas Intermediate crude rose 0.5% to settle at $84.94 a barrel, while Brent crude futures gained 15 cents to close at $91.02 a barrel. The big issue here is that hopes for a peace deal between the U.S. and Iran are fading rapidly. There were statements on social media indicating that the U.S. is not currently engaging in any talks with Iran and that the naval blockade remains in full force. On top of that, we had reports of geopolitical friction in the Red Sea, with Yemen's Houthis targeting vessels. All of this geopolitical instability keeps a premium on oil, which in turn keeps inflation expectations high and pushes bond yields even higher.
It's a vicious cycle. And this isn't just a U.S. phenomenon, is it? We saw yields spiking globally today.
Yes, this is a synchronized global move. Japan's 10-year bond yield hit a 3-decade high today. In Europe, Germany's 30-year yield reached its highest level since 2011, and the French 30-year yield touched its highest point since 2008. British government bond yields advanced as well. Because of this, European shares closed firmly lower. The Euro Stoxx 50 lost 0.9%, and the broader Stoxx Europe 600 fell 0.6%. Germany's DAX and France's CAC 40 both closed down around 0.8%.
Did any European markets manage to buck the trend?
A couple of exceptions stood out. The UK's FTSE 100 outperformed, managing a tiny gain of 0.07%, and Switzerland's SMI edged up 0.13%. In the UK, the unemployment rate held steady at 4.9% for the 3 months to June, defying expectations of a drop to 4.8%. However, there are underlying concerns there, as payroll employees dropped by 13,000 in July, and the retail and wholesale sectors shed about 75,000 jobs over the year. On the bright side for Europe, the ZEW indicator of economic sentiment for the euro area rose to 31.4 in August, which was a 6-month high and beat expectations. Also, Germany's property sector is showing signs of recovery, with apartment building permits rising nearly 14% in June.
That's a bit of positive news amidst the gloom. Now, before we head over to Asia and look at how those markets fared, let's take a quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were analyzing the market pressures in the US and Europe. Let's turn our attention to Asia now. It looked like a pretty tough session over there as well, particularly for tech-heavy indexes.
It was definitely a tough day. Japanese markets slumped heavily due to profit-taking in the artificial intelligence and memory sectors. The Nikkei average plunged 2.54%, while the broader Topics index fell 1.05%. Major tech players like Kyosho Holdings plummeted 7.6%, Tokyo Electron shed 6.2%, and Advantest declined 5.1%. In South Korea, the Kospi fell 1.55%, snapping a 5-day winning streak, with Samsung Electronics down 2.2% and Hyundai Motor losing 4%.
What about China and the rest of the region?
China's Shanghai Composite managed a small gain of 0.19%, helped by government policies aimed at boosting consumption in smaller cities, though their solar exports fell over 21% in July, marking a third straight month of declines. Hong Kong's Hang Seng also closed marginally higher. Down under, Australia's market was slightly lower, though mining giant BHP advanced 2.7% and biotech giant CSL soared over 17% on strong earnings. Over in New Zealand, the S&P NZX 50 rallied 1.05% to close at 13,866, driven by strong energy sector results. Meanwhile, in India, the Sensex fell 493 points to close at 77,235.
Let's pivot back to the US and look at some of the economic data that came out today. We had some interesting numbers on import and export prices, as well as housing. What did these figures tell us about the state of the economy?
The trade pricing data was actually quite surprising. U.S. import prices fell by 0.4% in July, which was the largest monthly decline since May 2025. This was mostly driven by a 7.2% drop in import fuel prices. Export prices also fell, dropping 1.3% in July, which is the fastest pace of decline we've seen since 2023. While this looks like a cooling of inflationary pressures on the trade side, the housing data painted a much weaker picture. U.S. housing starts plunged 12.4% in July to a seasonally adjusted annualized rate of 1.239 units. This is very close to the 6-year low we saw a couple of months ago. In addition, pending home sales unexpectedly fell 2.3% in July, showing that the housing market is really feeling the pinch of these high mortgage rates.
That housing data is definitely concerning. Let's move on to the currency markets. How did these global macro shifts impact major currency pairs? I know you have some technical levels and moving averages we should keep an eye on.
Yes, the Forex market is showing some very clear technical consolidation. Let's start with the euro against the US dollar. The Euro-USD pair closed slightly lower at 1.1574. It's currently sitting right on its 100-day simple moving average of 1.1569. This level is acting as immediate support. If it holds, we could see a retest of recent highs up toward the 200-day moving average at 1.1628. However, a break below this could see the pair pull back towards its 50-day moving average at 1.1467.
And how is the British pound holding up?
The GBP-USD pair is in a similar consolidation phase, closing at 1.3532. The pound remains in a healthy uptrend, trading well above its key moving averages. The 50-day moving average is at 1.3381, the 100-day is at 1.3420, and the 200-day is at 1.3417. As long as it stays above its immediate support of 1.3520, the bullish momentum is still very much intact.
And what about the Canadian dollar and the Japanese yen?
The U.S. dollar clawed back some ground against both. USD CAD closed up at 1.3899, finding support near its 200-day moving average of 1.3850, though it remains capped by its 100-day moving average of 1.3918. For USD JPY, we saw a continuation of its recovery, closing at 1.5966. It's trading above its 200-day moving average of 158.23 and is now testing resistance near its 100-day moving average of 159.98.
It sounds like the dollar is showing some resilience here. Now, the commodity space saw some massive moves today. Gold and silver both took a beating. What happened there?
It was a brutal session for metals. Gold plummeted 1.63% to close at $4,345. It sliced right through its 100-day moving average of $4,389. The sharp drop has wiped out a lot of recent gains, and if the selling continues, we could see gold test its 50-day moving average down near $4,155. Silver was hit even harder, plunging 3.44% to close at $63.52. It's still above its 50-day moving average of $61.36, but it got violently rejected from its higher moving averages, like the 100-day at $68.65. This sudden shift shows that sellers have taken back control in the short term.
To wrap up today's episode, let's look at some individual stock stories. We had some massive percentage moves in the market today. Who were the biggest winners and losers?
The standout winner today was Amylyx Pharmaceuticals. Their shares surged a massive 64% after announcing that their avaxeptide treatment met all primary and secondary endpoints in a Phase 3 trial for post-bariatric hypoglycemia. Another big gainer was Targa Resources, which closed up over 7%, leading the S&P 500 gainers after signing a 20-year midstream agreement with ExxonMobil.
And on the losing side?
Meta Platforms slid more than 4% as a major trial began where states are suing the company over alleged harm to children, with potential damages cited as high as $1.4 trillion. In tech, Chinese internet giant Baidu dropped 13% on weak second-quarter results. The buy now, pay later company Klarna tumbled 22% after slashing its guidance for the third quarter and full year. Finally, Fabrinet closed down more than 19% despite beating earnings expectations because of disappointing datacom sales.
Wow, some incredibly dramatic moves to end the day. That is all the time we have for today's episode. If you find this useful, please follow Market Brief After Hours. We'll see you next time.